This is Mark Anthony with Mercury Time Price Analytics, and welcome to the daily update video. Actually, this is a twofer tonight. This is the daily update video for today's holiday shortened U.S. equity trading session. It's also the companion video for our weekly update article, which we published Saturday or Sunday. Due to some other commitments, didn't have a chance to record a companion video, so this will serve both purposes. One of the interesting things I want to talk about tonight is these algorithmic time price regression lines that we put on the chart, which, as we posted on Twitter today, you break this blue one and there's cause for concern. You break this red one and the market has trouble. Well, you gap through it tonight. And we're going to talk about that in a minute. If you haven't been to our website, it's mercurysignals.com. Go to the website and just click the weekly report tab, and it will take you to all the recent weekly reports, and then just click on the mean kitty picture, which is the top one when you go to the weekly reports page, and you will get this week's report titled Mean Reversion. So we thought, why not put Mr. Mean Kitty for an article about algorithmic mathematic mean reversion? You've probably been hearing a lot of this buy the dip, buy the dip, buy the dip lately. Here's the problem. Right now, prior to today, I mean, it looks like this is going to change, but going into the weekend, ES and NQ were 3 standard deviations above the 200-day moving average. Now, consider how statistically rare it is to even get to a third standard deviation above the 200-day moving average. So the question I posed at the beginning of this week's article, titled Mean Reversion, was we are going to get mean reversion at some point. The question is what type, what degree, what nature of mean reversion are we going to get? Are we going to get no mean reversion? Are we going to get gradual mean reversion? Or are we going to get violent mean reversion? Now, here's the 3 other alternatives that you've heard incessantly over the last few weeks on Financial News TV. Buy the dip, buy the dip, buy the dip. The folks that are telling you to buy the dip relentlessly, when the market is 3 standard deviations above the 200-day moving average, that is probably the most irresponsible financial advice that you can ever get. And believe me, there's a ton of it on Financial News TV. And let me just say this, I've mentioned this before on videos. If you're a trader and you have the financial news channels on during the day, turn the sound off. Don't listen to them. They will give you nothing but bad advice. Now, here's the issue, and I'm not going to read the whole article, but I just want to set up a couple of charts. Apple, Microsoft, Amazon, Facebook now account for about a 14% weighting in the S&P 500. And they tell you to buy the dip. Well, what happens if you lose one of those generals? Just a modest pullback in one of those market generals, and you've got a big problem. Then you've got the coronavirus, which is an unspeakable human tragedy. And I have to preface this by saying anytime we talk about the coronavirus, unfortunately, we have to talk about this because it pertains to the tape. But we all understand the human tragedy here. So we're simply talking about the market. But these same people that are telling you to buy the dip while Apple, Microsoft, Amazon, and Google account to 14% weighting approximately in the S&P, they're also telling you buy the dip. It's going to be a V-shaped recovery regarding the coronavirus. No, it's not. Because the supply chain disruption that has already occurred is going to do damage. Hence, Apple coming out late this afternoon and announcing that they're going to miss their guidance. Again, you lose one of these generals, even with a modest pullback, you got a problem. So I want to show you a couple of charts. We've got a number of different algorithms. And one of the things we have an algorithm for is to show corrections. Now, this particular algorithm, there's 2 of them, but this particular one, I want you to focus on this purple algorithm that runs through it. You can see that a number of these times where you get the corrections, you get these moves that are very angular, and then you get the break. And you get another move here that looks very unnatural, and you get a break. You got another break here, you've got another break here, you've got another one of these bizarre angles that is typically unnatural, especially given a very long time cycle like we're using on this chart. You get another break there, another one there, another one here, briefly breaks the line, comes back, and I ended this last little shaded oval with question marks, because you can't keep doing this without something more important breaking mathematically. Now let me show you our correction algo on an even longer time frame. And this is all in the report. Just go to the website and you'll find all this, along with a cute picture of Mr. Mean Kitty. I do not know if he's related to Smelly Cat. There's a rumor. I have not been able to verify that. Now, since the Fed has been pumping over $1 trillion into of liquidity into the system, starting back in September, notice there were no sharp breaks. And this is a longer correction algorithm. This is the long cycle correction algorithm. It's longer than the chart we just looked at. Notice there were no sharp breaks of the purple algo in November. There was one in January, first couple trading days of the month. I'm sorry, December, forgive me. One in December, none in November. So that's what $1 trillion of liquidity pumped in the system will get you. Well, the reason the central banks are concerned is not just due to the coronavirus, but because of the fact in January, the effect of all that excess liquidity over $1 trillion is starting to lose its impact. No sharp breaks in this algo in November, one in December, 1, 2, 3 in January. So the market is getting at a very precarious level. Again, 3 standard deviations above the 200-day moving average. Now, I want to take a look at this chart, and this is an update of a chart that was in the previous week's report, which was called Calm Before the Storm. One of the most amazing charts I've ever seen is what you're looking at right here. Because what's happening when Globex opens, more often than not the last few weeks, we get a ramp up when Globex opens, and the primary reason for that is when China reopened after the Lunar New Year holiday, it gapped down 8%. So over $1 trillion was pumped into the market. There was a ban on short selling. This is China we're talking about. Over $1 trillion put into the market, liquidity. Ban on short selling. Additional liquidity measures for banks. And so we got this move up. Now, prior to the Chinese market reopening, you had a head and shoulders top. And let me take a step back because I just botched the whole setup. What you're looking at on this chart is SPY, but day session only. This is the S&P Spider. Because you're getting these moves up in Globex that are then followed by the U.S. equity market open. And more often than not, over the last couple weeks, we've seen ES struggle all day long just to get above the opening print. And by opening print, I'm talking about 9:30 Eastern Time open. That's the first print at 9:30. And if you go back and look at last week and the week before, you'll find numerous days where ES traded all day long just to barely eke out a little move above the opening print. That's not healthy action. So you're getting these ramps up in Globex. But the U.S. equity market hasn't been able to get out of its own way for 2 weeks. And so what these regression lines are telling you is that all it's going to take is a spark. You break these 2 regression lines, you got a problem. Now, the most bearish thing you can do is to gap through support. Just like the most bullish thing you can do is gap above resistance. It hopped right over. And we'll talk about that more in a minute. But these Globex opens, and I tweeted this out today, these Globex opens that ramp the market up are actually creating a more dangerous situation not making it less dangerous, because when the US market opens, it literally can't get out of its own way. So let's take a look at this SPY chart again. And this is all in the weekly report. So this is SPY US day session only. There is no Globex. This is the most remarkable series of patterns I've ever seen. You got a head and shoulders top into a waterfall decline that created an inverted head and shoulders bottom that then started to form another head and shoulders top. Now, if this broke, you know, it's like taking a rubber band, a really thick rubber band, not the ones that come like 500 to a box, but a really thick rubber band, and stretching it as far as you can, and then stretching it as far as you can in the opposite direction. Then a third time stretching it as far as you can in the opposite direction again. That's the wind-up that you had into here. Well, what happened Sunday night Globex? Not yesterday, but the Sunday before. You had a fast move down to 33.04. Then there was a Reuters report that hit that said that the major Foxconn factory that produces the majority of iPhones in China was going to reopen. And that report came out, not coincidentally, just as that Sunday, again, Sunday a week ago, as the futures went sliding down to 33.04, that report from Reuters comes out, boom, and you get this goofy move up that is completely out of context with this and this. Now, it turns out that that Reuters report was discredited. And I'm not saying that let me rephrase that. Not that the Reuters report was discredited. I'm not calling into question the reporting. But Chinese authorities denied that that order was given to Foxconn to reopen. And again, Foxconn is the major iPhone manufacturing plant. So the problem is, all you've done with this is potentially created another head and shoulders. And if this breaks, I mean, literally, you could see a couple hundred handles in downside in ES over a short period of time. I'm not talking about a day, but a short period of time. And if you question that, I just want to point out that this morning's NQ all-time high was 96.87. It was down 100 handles on the open this evening. So there is no precedent for this. Head and shoulders into an inverted head and shoulders into another head and shoulders, nor for this crazy, goofy move that we had last week. You know, where Sunday Globex, you go down to 33.04, and then you start printing 33.80, almost 33.90. And this is the reason on Twitter, in our Slack channel, on our live chart for our subscribers, we've been constantly taking short entries. We have not been taking long entries the last couple of weeks. Why? Because the risk-reward ratio, or more accurately put, the reward-to-risk ratio, is horrible, because what you got tonight could happen at any time. All it takes is one news item. One news item. That's all it took. And then you take one of those generals out, in this case, Apple, and just like that, off the open, you're down 100 handles in NQ. Now, what's interesting about these regression lines is, and if you've watched our videos before, I've mentioned many times that you can't build an algorithm anchored to price, because price is linear. Price literally starts at zero, hypothetically goes to infinity. You can't anchor anything to that. You have to have an algorithm that's built predominantly on time. So these regression lines are time-price regression lines, and price will fight over them and release. Fight over them and release. Here you had it release, fight over it, release up. It fought over it, release down. And then sometimes it will just knife right through. Well, the problem is, if it's a fake out move, and in this case a nasty short covering move, then you get the opposite and it comes right down. Does that look familiar? Look at that. And take a look at this. You had a big move down, a crazy move back up, only to come back down even harder. That's the same thing that's being set up right now. Now, I posted on Twitter this chart, and I think I've got an earlier version of it. Here it is. This is the picture that was posted on Twitter this morning. So you had this regression line break last Thursday, the 13th, into the close. Or not break, but ES traded below it into the close last Thursday. It did the same thing Friday afternoon. Then all of a sudden, in the last 45 minutes, you get this magic yellow brick road ramp to negate closing below this blue, actually cyan regression line 2 days in a row. And by the way, it closed below this regression line the previous Friday, February 7th. And when I put this picture on Twitter this morning, what I mentioned was, if you break this blue regression line from up here, it's a problem. If you break this red one, it's trouble, big trouble. And what we saw this evening, Globex open, not only was it broken, it gapped through it. That's not good. Forgive me, and let us turn off the notifications. All right, so back to our regularly scheduled programming. And then, since I'm a one-take kind of guy, we're not going to do that last 16 minutes over again. A couple other things that I wanted to point out. Remember last week, huge battle over the 74 to 76. It's battling over that right now. One of the interesting things that our algos do is they find high volume areas. So today you've got the X4 pivot right here in this area at 33.75. And if we pull this chart back, well, where is it getting that from? Well, it's pulling from all this volume here and here and here. And so that's why these algorithmic pivots are so accurate, because it's finding where all that heavy volume resides. Best way I can describe it is, you might have seen charts where you can put the volume on the vertical axis. I always do that. Vertical axis. And it looks like little mountain ranges with small peaks and then big peaks. Well, the price levels that our algos generate will coincide with peaks in volume. And I don't even look at those type of volume pictograms. But I guarantee you, if you looked at one, I guarantee you there's a big one between 33.74 and 33.76. You can see it right here. Now, these X pivots are very important. These are levels at which the institutions either step in to buy the dip, or, as it looks to be this evening, step away from the bid. This level here is also very important. It's a tick point of control. As I mentioned on our live chart about an hour ago, that this is likely all you're going to get tonight on the upside. Fortunately, I'm already in a short position, and this was called out this morning at 11:32, short entry 33.89 with a stop at 92. And then we had this news this afternoon, Apple just cut guidance. Now, we trade in thirds. And what that means is, when the trade starts going your way, you look for a spot to take a third of it off, then you adjust your stop, and then you look for a spot to take your middle third, and then you look for a spot to take the last third, which is called the runner. So that first third of the position was taken off at a plus 15. I'm not going to tell you that happens all the time. This market's been so crazy lately, it's been hard to get three handles out of that first third. But what prompted me to put out on our trade alerts to go short this morning at 33.89? It was a number of algorithmic indicators. It was also this. Now, and this is one of the most important things that I could show you this evening. I want to put in context how silly it is that everybody on TV is telling you buy the dip, buy the dip, buy the dip. I want to take a look at this chart. Does that chart look like it's trying to put in a bottom? You came down here, you had this bottom, and came a little bit lower here and held, moved back up, came down below this and held, came down again and held, and you can see all these spots where it's coming down just below this and recovering back. That looks like that's trying to put in a bottom, doesn't it? All right, let me show you a zoomed in version of this. Now you can really see that this thing's really trying to put in a bottom. You know what this is? This is the ES futures chart, only it's inverted. Now, if somebody came on Financial News TV and showed you this chart, and you didn't have these numbers on the side, which kind of gives away that this is ES, but they showed you this chart, or they showed you this chart and said, you know what, we're really bullish this instrument. This really looks like it's putting in a bottom here. You'd say, you know what, that's a pretty good chart. Only problem is it's the ES chart inverted. The top is the bottom and vice versa. So while these people are telling you, buy the dip, buy the dip, buy the dip, well, that's not what the chart tells us. You look at it from an inverted perspective, and it puts it in a completely new light, doesn't it? And this is exactly why I've been indicating to our subscribers that the risk right here for the last couple of weeks, the risk is to get long at these levels. The risk is not to find setups that you can short with good risk management. And so that was why our algo got short this morning, and that's why this call at 33.89 at about 11:30, what was that time precisely? 11:32 this morning. Now, lest you think that we got lucky, let me go back. Short entry off the open on the 29th, 32.87. You get this move down to 32.20, 32.40. On the 30th, short entry off the open, 32.94. Just a 75, 80 handle move down, 80 handles. And if we pull this back a little bit further, if I could pull this back further, but it won't let me, you could see the same thing. Short off the open on the 22nd, the 24th, the 29th, the 30th. And here we are again. Short at 33.89 with a gap down through both the cyan regression line and the red. And the way to interpret this is just like I mentioned on Twitter this morning. You get a move through this cyan regression line, it's a problem. You get a move through this red regression line, it's trouble. And you had a big old nasty gap through. Now, it's coming down into another regression line. So as I mentioned when Globex opened about 15-20 minutes into it, we should see at least some momentary support down here, 71.72, and that's exactly what we're getting. I don't know how long it's going to hold, and you know, it doesn't really matter. We're short from 33.89 and took the first third of the trade-off at plus 15 handles. So please do take a look at this article on our website. Very, very important. A couple other things I want to point out. This was the setup going into this weekend. So I showed you those regression lines just now. I showed you the regression lines as they looked this morning. This is the way they looked over the weekend. Same thing. You had a break on the 13th. You had a break going into Friday's close. You got the Magic Wizard of Oz move up. And there's only so many times that they can rescue this thing. And this chart bears one more look. $1 trillion worth of liquidity that was pumped into the market starting in September. That gives you no corrections in November and one correction in December. But 3 sharp moves down in January? What does that mean? It means you get to a point of diminishing returns. And that with all the incremental liquidity that's pumped into the system, it's having less and less and less and less and less effect. And we closed this article with a quote by someone who's much, much smarter than me, and I mean that sincerely. Scott Minard from, or Minard, if I mispronounced that. It's Minard, I believe. Forgive me. Chief Information Officer of Guggenheim. He's only responsible for directing a $275 billion portfolio. And I'm not going to read this quote to you. You can find it on the website in the article. But you've got a gentleman who's very, very knowledgeable. Scott Minard knows his stuff. You don't get to run a $275 billion portfolio if you don't. I've never in my career seen anything as crazy as what's going on right now. This will eventually end badly. So if you go to the website, you can find this article. And you can also find last week's article, The Calm Before the Storm. There's also a very long, it's about 45-minute video regarding Calm Before the Storm. And let me just leave you with this. If you haven't been to our website, it's mercurysignals.com. We do run a trading service. The trading service, we have two separate services. We have one service that gives you ES and NQ. We've got a separate service that gives you bonds and crude oil. Now, with that service, you get a live chart that runs on Zoom. All you need is a free Zoom account. We give you a new passcode every day, and that live chart runs 23 hours. It runs from the 6 p.m. Globex Open up until 5 o'clock the next day. And then after that, we give you a new code for the next 23-hour cycle. So you have a live chart on Zoom. We just got two examples. This is our day trade algo. This is our swing trade algo, both of which got short today. But what's really helpful, especially for new traders, is I'm on the live, on the mic, on the live chart almost all day long. You know, my mother is 94, and she will tell you, I'm 57. She will tell you that from shortly after I was born, I haven't shut up. And hopefully that's a good thing for our subscribers, because if you're new and you're wanting to learn how to trade, we will teach you to trade like a professional. Now, as always, past performance is not indicative of future results. We are not promising, guaranteeing profit, but we will teach you how to manage risk like a pro. And at the end of the day, it doesn't matter whether you're trading the market long or short. What is important is risk management. Beginning traders get really caught up with their win percentage. What percentage of trades am I making money on versus the percentage I'm losing? That is absolutely not the right metric. The metric that you need to watch is risk management, because you can be wrong more than you're right. Substantially, you can be wrong percentage-wise substantially more times than you're right. But with proper risk management, if you're giving back a couple handles when you're wrong, but you're booking 10, 15, 20, 30 when you're right, that's how you do this as a profession. We will teach you how to do it. If you're looking for a mentoring program to trade full-time, or you're just looking to trade part-time, again, we cannot guarantee results. We will not guarantee results. But our results are pretty darn good. Over 600 handles in January. One losing day in December, one in January. Both were less than 3 handles. And so far, one losing day in February that I think was about between 3 and 5. Very frustrating day, but it doesn't happen very often. And because we manage risk, when you're wrong, and you will be wrong if you're a trader, we manage risk and keep those losses very small. We keep very tight stops. But if you're looking for a mentoring program, I do not know of any mentoring program that gives you the depth of resources with our algorithms, with the live chart, with me constantly being on the mic. I've been trading over 35 years. In addition to the live chart, we've got a Slack channel where every trade is posted. Every trade alert is put out. You can have these pushed to your smartphone, to your tablet. Never miss a trade alert if you don't want to. Of course, you can turn them on in the middle of the night. But this all comes with it. And let me say this. Anybody who tries to sell you any type of subscription to anything market related, if they can't show you this, don't waste your time. If they can't show you this, there's a reason. You can go on our website as a subscriber on our Slack channel, and you can see every trade recommendation as far back as Slack will let you go. So with our subscription, you get the live chart, you get the Slack channel. On the Slack channel, you also get all of our chart updates, which is under the Charts tab. You get all of our pivots, an enormous amount of information. All of these algorithms are proprietary. You can't find these anyplace else. These are institutional level services that we simply make available for individual traders. What does the service cost? Well, again, there's two programs. There's our ES and NQ trading service, which is what you're looking at. And there's our bonds and NQ, which is absolutely crushing it. So it's two separate services. You can have both. You can pick either or. We have these subscriptions way, way underpriced, and they're not going to be at this price much longer. The ESNQ, for example, it's $68 a week. We bill bi-weekly, so it ends up being $138 every 2 weeks, like $68 and change. You can go right on our website, go to the subscription page, and it'll give you that information. But we bill bi-weekly, so you're not locked into anything long-term. You're not even locked in for a month, for that matter. We bill every 2 weeks. Now, what we do that's really interesting is, although we don't bill you monthly, so you're not locked in any more than, you're not locked in at all, but you're never paying for any more than 2 weeks at a time. But not only do we not bill you a month in advance, but we give you a lifetime rate lock. When you join our service, you will not experience a rate increase no matter what rates go up to, and they will be going up soon. They were supposed to go up February 1st. We decided to wait a little bit. But, you know, for what it costs a week, $68. If you trade the ES, for example, one ES E-mini handle is $1. So just now, if it went from 33.72 to 33.71, it's $50. I said $1. I meant $50. And here you have on one trade, a third of this trade since this morning, 15 handles times 50. You can do the math, and that's on the first third. As price comes down into this next proprietary pivot, that's where we'll probably look to take a little bit more off. But what we do is we teach you to manage your risk and to trade in thirds. So as that trade is moving in the direction intended, you're taking your profits off a little bit at a time. So please take a look at our website. Again, having done this 35 years, and not running this particular service 35 years, but having traded 35 years, there is nothing on the market that gives you the kind of value and the type of mentoring program that we have. So we thank you so much for your time. This video is going significantly longer than we had intended, but we thank you so much for your time. God bless you, God bless your family, and we hope to see you again very, very soon.